1,000% APY. Who wants to make a lot of money? So, yeah, this is the crypto dream, isn't it? You're going to 100x, 1,000x on your investment. And maybe, just maybe, you're going to use DeFi or something like DeFi to get enormous returns on what you've invested. Any of you who haven't seen an opportunity like this probably haven't been on crypto Twitter, because it feels like they're there all the time. So here today, we're going to be unpacking a little bit. Do these dream opportunities exist? If they do exist, what does that mean? And then really, this is going to boil down to one thing, a conversation about risk, because that's what this is all about. And so joining me today are 4 of the leading experts on Earth when it comes to measuring this risk, looking at it, and the opportunities that come from it. So let's talk about kind of the most exciting part of this. Tell us a little bit about kind of what we're seeing in newfangled DeFi. We see 1,000% APY sometimes from, let's call it, maybe very strange underlying tokens. Tell us a little bit kind of like some of these 1,000% APY promises. How are they being made at all?
Yeah, so I think what crypto has done, at least when I've been in the space for about 7 years, it's really changed my concept of understanding what value is. Because before I came from TradFi, traded commodities for a long time. The framework for value was rooted in scarcity or utility. Crypto's kind of changed that, right? Because a group of people get together and say this thing has value. And so if you start to believe that framework, then in theory, anything that has a community or some group of people that get together and say this has value, then that's acceptable to those people. And then if they print more of that thing that they say has value, then that's usually where this 1,000% APY comes from, right? Because
so you're saying it comes from the fact that a bunch of people believe, let's call it a brand new token that's, I don't know, premiered to the market. Mm-hmm. Some people decide it has value. It shows up on CoinMarketCap or something, yep. Right? Other people believe it, and then there's a bunch of inflation, and maybe as inflation rewards, this new token is being issued in order to get excitement. They'll be airdropping it. They'll be finding some sort of distribution method and hoping that people continue to believe it's worth that same price.
Yeah, exactly. I mean, ultimately what matters is people think this thing is valuable today, but it will be worth much more in the future. And then, if enough people believe that, then collectively you've created value for that community. Other people might not believe it, but that community might.
So how often does it actually net out at 1,000%? Because it sounds to me like, to a certain extent, maybe there's 1,000% quote-unquote rewards, but it's very possible that while that's happening, there's a 10x drop in value of that asset.
I would treat it no different than VC investments, right? Like 99% of early stage investments go to zero because somebody thinks it's going to be worth more. But you have one that turns out like an Athena or a Bitcoin or a Ripple, and then that community has made a ton of money. And so if there's people are constantly chasing that dream, right? And even if 1 out of 10 works, then that's enough of a success story for others to come and do the same.
Javier, what do you think?
Yeah, no, I was just going to take one step back. I mean, where are you based? Where do you live?
I live in Miami.
Okay, well, you probably not remember this, but I remember probably, I would say 10 years ago, interest rates in the UK were significantly low, or actually less than that. And there was this concept of what is called, kind of a fintech sort of banks, okay? And there was the ING Bank. I don't know if you guys remember that. This comes with an interest rate of 10%, where interest rates were actually around 2 or 3%. So it was kind of
that sounds so exciting investment opportunity.
So I think what is actually mentioned this to you is because if you think about it, I mean, a lot of the tokenomics that exist in some of the projects is kind of a marketing tools for attracting and building communities, which is to some extent what Anand is saying. So now you can think about the cost of getting one client into your ecosystem. You can actually pay them $50, $100, or whatever it is, or you can actually give tokens to them. Now, the question when people receive tokens, what is the utility of that token? And that utility of that token is going to be encircled with regards to, well, what is the ecosystem? What is the community? What is the service that you're actually going to be able to apply on this?
Well, you're hoping that there's some sort of, it sounds to me, some rationale behind the maintenance of value of that token.
Correct.
Is that correct?
And the utility of what are you going to do? So you receive tokens, and those tokens, what are you going to do? Are you going to buy some more services from that ecosystem, from that community? And that's where they
Because that could be an on-ramp, or at least not an off-ramp of the capital. Would that be correct?
Correct. In some ways, you're going to be saying, okay, well, I can go now and buy X product. I can utilize this to place collateral. I can utilize this to pay for trading fees. I can utilize this for multiple different other services. So again, that's going to be in function of how large is that community, what ecosystem is growing. So it's a bit of a spiral effect. But at the end, you can think about those tokenomics, and to some extent, it's like a people buying clients into this. Okay, and that's what we call, to some extent, inflation.
Evgeny, is there a lot of demand for this? Because again, it sounds like a Ponzi scheme that might be kept up by a house of cards that might work because enough people believe in the house of cards not falling yet.
No, I don't think it is that. You have to be careful about it as well, because again, generalizations are probably quite extreme. But the point that I'm trying to kind of set here is important, is that you actually receiving that for some utility that you may apply in the future. That utility can disappear or may not actually happen. But there was some concept.
But this wouldn't be with 1,000% APY, maybe, right? Or could it?
Cool.
Okay, fair enough.
Yeah,
so, Evgeny?
I think I'm quite a bit more skeptical about this stuff because, I don't know, for me, I can also go back down the memory lane. Like I was born and raised in Soviet Union and then Russia. And in the beginning of 90s in Russia, we had this, it was pretty much financial pyramid called MMM. There were like a lot of others as well. And it was pretty much the 1,000% APY stuff. And the big difference was it actually had adverts on TV about like bring money and get even more money. And it worked until it didn't. And ultimately it collapsed. And there was definitely a community, a very like die-hard community.
How'd they feel after it collapsed?
A lot of them didn't believe it. A lot of them believed that it's the government caused the collapse, not the thing was not sustainable in the first place. And I think the thing is this. I don't think I've seen a single 1,000 APY opportunities, and we've seen them, for example, back in 2020 with, I don't know, for those who were around.
Well, DeFi summer.
With food tokens. There were a lot of food tokens like yams and what's not. It was pretty crazy. None of them survived. None of those like 1,000% opportunities survived. Like they all pretty much died.
Okay.
And there was nothing sustainable in it. It was, and I don't think people, maybe some people joined it as a community, but ultimately most people joined it as a game. And everyone knew it's a game of hot potato. So
it's kind of fun.
It's fun.
It's like gambling.
It's a hot potato game, yeah. You keep accumulating, you keep, I don't know, getting this 1,000% APY, but everyone who's been doing it for some time knows it will inevitably come crashing down. So
I was going to say, this sounds to me like a fun, to your point, kind of game. It sounds like you people are using kind of capital they're willing to take massive risk with. I don't think institutional investors would probably be very interested in these types of opportunities. Do you?
You're asking me, right? Yeah, I have a lot of thoughts. The first thing is I think it's quite interesting to say that, they do exist, but you got to find the needle in the haystack and then put a lot of hope in it. And what is the chance that's going to happen and who actually has the time for that? Most investors who've made their money outside of the digital space are just not going to do that. It's inconvenient, it's too hard. And they will put their money in blue chip, or they will put their money in VC and then make people like Anand make sure that some of that return comes back. So that's the first thing. And that's also what we see in Asia. Private banking clients and big institutions, they focus on Bitcoin and on
So I just want to provide a little bit of context here. Essentially, you have one of the largest book of high net worth individuals and institutions in Southeast Asia for sure. And so you actually see kind of where they're deploying capital.
Yes. So we see the Bitcoin, ETH, specifically those that didn't, like I said, that didn't gather their wealth as digital asset natives, but in other sectors. And to them, it's just an asset allocation. It's part of their portfolio. And they want some exposure, and that's what they buy. And then they do some investing in VCs to get some exposure to more alternatives, but very little interest, it seems, into getting that one.
And have you explored with them like the prospects of DeFi? I'm sure you thought about it within the bank.
So when you think about it, there might be some that look at it, but to most of the of the high net worth. It's about convenience, and it's about, like I said, they have so many things and so many options. Looking at one particular area might just not be what they have the time for to do, and they leave that to others to do, and it's also not a necessity for them to do that.
So they're willing to take, so it seems, perhaps a lower return profile, but it's a hell of a lot more convenient, and they can use trusted parties to do so.
Exactly.
Okay.
I would even add to that there is an added risk for any serious institutions to participate in those games, because imagine if, let's say, BlackRock decides to go and go into one of those 1,000 APY tokens.
Sounds fun, actually.
Well, sounds fun, but then the headline is BlackRock buys XXX something, and then a week later the thing collapses. I'm not sure whoever was in charge of this at BlackRock, even if they actually exited, is going to be happy about this.
Actually, that's a very good point. So theoretically, you can have 1,000 APY, but can you exit at 1,000 APY?
Yeah.
Because if you're the only one holding it, I mean, your 1,000 APY is just theoretical. The moment that you start selling, the whole thing crashes. And you hear that many times where people are very excited about that one token they bought, and it's gone up so much. But you always have to discount for
It's just completely notional
selling.
value is what you're saying.
Yeah, what I mean is if you own a very large chunk of that asset, it's no different from in traditional finance. Huh? If you hold a large chunk of that asset, the moment you start selling, you will start impacting the price if there is low liquidity and there is a low market cap.
Yeah, I mean, so I guess what we all kind of are saying here is that what is the risk management framework that people can apply to actually evaluate that?
So what is a risk management framework?
And who's going to do
the thing? My issue with with the title of this thing is it frames it as if it's a binary thing.
Yeah.
And it's not. It's risk adjusted, right? Like everything is risk. Liquidity is a risk. Smart contract risk is a risk. Rug risk, which is credit risk.
I do want to go into the different types of risk and unpack that a little bit. So let's just wait just a moment for that. But you're saying essentially there's a gradient here.
Absolutely. I mean, why 1,000%? But like, there's products and yields out there that's giving you 50. Ethena, which is very successful protocol.
Yep.
When the basis is doing well, it gives you 60%. So if 100%,
and that
is
seems
like,
sustainable based on what we've seen this far.
At the time when there's demand for leverage in the market, it will pay it. If it's not, it's not. Nobody's saying you're going to get 60% in perpetuity, right? I mean, yes, the APY framing in that sense is misleading because you're not getting 1,000% in perpetuity, but for, let's say, 2 months or 3 months, you're getting a ton of return. But on a risk-adjusted basis, sometimes these things exist, and if you're smart enough and if you know what you're doing, you can find some of these things. It's just that this framing it as if it's like yes or no thing is that. I mean, I think that's unfair.
Yeah. And the other thing that I think is probably an interesting point is that the biggest contribution of DeFi to this is that it allows people to be able to monetize on that sort of anomalies, if you want to call it. So, for example, the carry on the funding trade. Okay, so it's pretty. I mean, any person who actually have a bit of talking about the risk and evaluate the risk framework, they can actually have the access to that. You may say it is not 20%, it's 50%, it's 100%, but actually before these people don't have any access to
There was no access to that.
No access to. So you only bought. I mean, there's only institutional actions, but hedge fund managers who would actually need to basically monetize on those opportunities. No? So I think, what I'm trying to say here is that, DeFi is a great melting pot for innovation. And then you're going to have all these outlayers. I mean, we said, okay, well, 1,000% of, a lot of us, we disagree that actually probably that could be fiction. But it's a continuous, no? It's a scope of different things.
So we've seen, for example, in recent years, that like, for example, centralized lenders not too many years ago were offering pretty high interest rates. We saw they weren't 1,000%, but we were seeing 11, 12, 13%. These were, again, historically low interest rate environments. They were offering this, and they were called companies like Celsius. Mm-hmm. And then a funny thing happened. We saw Terra Luna crash, and then subsequently we saw these centralized lenders collapse overnight. And it turned out that those, I guess, those promised returns, or at least potentially promised returns, evaporated. In fact, people lost their shirts. But we didn't see that so much in DeFi, did we? Things like collateralized lending platforms like Maker seem to survive quite well. Evgeny?
Well, I mean, you can argue Terra is very much DeFi. So
Yeah. I mean,
there's a very bit of losses there.
I mean, basically, I don't think this is a DeFi versus CeFi thing. The things that survived were the things that were collateralized. Even in DeFi, most things are 100%, 110, 20%. They're over collateralized. So of course they didn't go under because they were collateralizing them with things that had actual value. The centralized lenders went bankrupt because they're idiots. Like they were lending unsecured and against promises like, okay, I have $1 billion in my bank, and literally there were things like this on Twitter. So I mean, that's just bad underwriting. I don't think that's a DeFi versus CeFi thing. Yeah. A lot of people claim I'm in crypto, so this is going to sound bad, but a lot of people said, oh, DeFi made it. DeFi made it because it's just properly collateralized. It's pretty simple. I don't think it was a victory for DeFi in any way. If DeFi was able to do uncollateralized lending and still survive, that would be a victory.
Well, hold on. But isn't DeFi a heck of a lot more transparent? You can see the code conceivably. There are smart contracts that one can assess.
Yeah, but this has nothing to do with transparency. This is just like you can go to a bank, and if you just collateralize it full 110%, that means there's value backing the asset. Whether it's transparent or not, there is a contract there that you can. The transparency is another dimension, in itself. But it's not the point that I'm making. DeFi survived there because it was just way more collateralized, nothing else.
Mm-hmm.
Okay. Well, let's go back and talk about some of those risks. We're going to go back and say this phrase again many times, I think, on this panel. Risk-adjusted yield. It seems to me like that's what everyone really should be chasing as opposed to any individual yield. It's a lot more realistic. And whether your risk tolerance is quite lower, you might be willing to accept a more reasonable rate, Evie. But back to the risks. What are the types of risks people see in crypto that perhaps are rather native to crypto as opposed to TradFi? I heard smart contract risk. What's that?
Yeah, I mean, fundamentally, risk is the same. It's just transformed into something else. In crypto, smart contract risk is just credit risk, but expressed through the risk that you have in the smart contract itself. But you're just replacing credit risk for smart contract risk.
So you're defining it that way, but I mean, quite literally, what is it? Do you see what I'm saying?
It's like the risk of the contract, being, some faulty code being written, somebody exploiting it, using an Oracle manipulation. There's so many types of ways you can manipulate the smart contract in a way to extract value. So that's smart contract risk. But then there's liquidity risk. There's all kinds of
so I mean, it's something you see all the time, of course, as a trading firm. Mm-hmm. Liquidity risk and counterparty risk. Tell us a little bit about kind of how that works in crypto.
Yeah, I mean, it's pretty similar. I think liquidity risk primarily comes. Like one pretty big type of exploits is Oracle exploits, and those are much easier to achieve if liquidity is very low. Mm-hmm. You see all kind of patches around this. So, I mean, some lending protocols, for example, hard code stable coins with low liquidity to one or to some other stable coin with high liquidity. It's a way to plug this risk. It introduces additional risks and all, but it's a possibility. But ultimately, liquidity is mostly related to basically Oracle kind of exploits. And I don't know, it's counterparty risk is not per se, if a smart contract gets exploited or fails in some one way or another, there is no legal contract to fall back to.
And that's a little bit frightening. Seems like a very, very large, perhaps not fully accounted for risk, Javier.
Yeah, and I think I think probably the two main ones have been mentioned, but just to stress, to me, what is actually important is that people have to kind of establish some sort of framework about how they evaluate those, basically, let's call it investments. Okay, so to me, assessing the protocol. Now you can find companies potentially they can audit it. Okay, they can audit those smart contracts. Okay, so you can actually have some external party they can tell you.
Although I will say there is a database called the RECT database of all these different DeFi protocols and others that have, despite being audited, somehow failed.
Sometimes, but what I'm saying is that you cannot
REKT, by the way.
You cannot rely on one single metric, so you have to have a series of different steps, and that's what is a framework.
Fair enough.
So you have to have that.
The flip side, the antithesis to that, on that point, is also how many audited companies in TradFi were fraudulent. Yeah. So by the big four, everybody used their testing. Banks were saying yes, this was amazing.
Well, look at Emerald, for example. Fraud, I mean, so absolutely. But let's go back to finish my point 1 second. I'm sorry. That the other thing that I think is actually quite important too is that, you need to assess what the community is all about. You have the blockchain. You can actually see what the wells are moving. What is the oracles that are actually feeding? We mentioned oracles here quite a lot, but actually those DeFi platforms can generate a lot of the liquidation risk. If one of those oracles, the data hasn't been transmitted properly, or there's some manipulation on the smart contract, or manipulation on the sort of feeding of the data. So there's all these different things that people can actually make some assessment and do an educated decision about what potential risk are you having with this particular protocol.
And this is likely, I would think, what experts in the space and funds that specialize in the space are doing, is building these frameworks. But Evy, you had something to say.
I was going to say, when you guys are talking, imagine this room filled with your average investor. I mean, they wouldn't absolutely have no idea what you're talking
a good point.
about. And to ask of somebody to go and do all of that research on their own in their free time on Saturday when they can be playing with their kids, you have no chance.
I love it, but that's basically why
but
I think it is so.
Whoa, hold on a second. I think that's a fair point, Evy.
Correct, and that's why and that's why we do.
Yeah.
I totally agree, and that's why we.
Yeah, I'm totally agree.
For
with
example,
her.
I mean, we have an active management business.
Yes, exactly. That's
Right,
what I was
so
gonna
that's
say.
why you said, okay, well,
That's
I mean,
alpha.
that I'm going to actually do that by myself, or should I basically look for someone who can actually help me to make those decisions? And by the way, TriFi is full of active managers, and there's a very precise industry. You invest into a private equity fund because you look for an advisor to kind of do due diligence on a lot of different investments that actually do that.
Absolutely.
Correct.
Nothing's fundamentally different here. It just manifests in a different way because the technology is new. But the risk, there's nothing new in crypto that there's like, oh, this is a new risk that's emerged in crypto that doesn't exist in TradFi. There's always an analogy. It's just expressed.
An analogy, but that's not necessarily the same thing.
It just manifests.
There is one big difference actually, because of smart contracts being transparent, because blockchain being transparent. Basically, if you have a financial institution or like a player, like whatever, like let's say a trading firm, if a trading firm hasn't exploded for 10 years, it doesn't mean that it cannot explode on the 11th year, because you still don't have no idea what's going on inside. If you have a DeFi protocol like Ava, which is the same version, which was not upgraded, which has been working for years and years, and has like billions in TVL, I think it's basically the longer it goes, the more you can be sure that it's actually fine, and it's not going to be exploited in any way.
But that's not always true, right? Because for example, like
it's more likely.
It's more, the Lindy effect kind of works for you. But for example, like a disruptive technology like quantum computing comes around, and then and everything's up.
Well, that's a totally different type of risk, right?
No, but my point is, it just time in itself doesn't make something bulletproof. Because things come up that because the new technology.
Ozymandias would agree.
Yeah, so it's just, my point is nothing is just like permanent, right? You have to constantly evaluate whether this thing is risky.
All right, so I'm going to take a bit of an aside here for a moment. I want to understand kind of how people that aren't able to chase this dream with DeFi, perhaps with active managers, how are they making money in crypto right now? And is it just, are they more or less buying Bitcoin hodling?
Giving your money to Evy and Javier right here. Right? I mean, this is why these folks have such great businesses. Yeah. It's alpha, right? If I can do something and give you access to an asset class, I mean that's my.
I totally agree. I think it's skill. I mean, you measure active performance of a managers in function of how much return they generate in a risk-adjusted basis. No, so what sort of risk? I mean, you can see now there has been a lot of coverage in the financial media saying, oh well. A lot of the active managers in crypto basically underperform Bitcoin returns.
Relative to Bitcoin.
Okay, but what is actually kind of
I might wonder, are the investors who are buying from Evy and buying Bitcoin and holding, are they making more money than a lot of these hedge funds?
Listen to this, which is what is missing in that article, what I think it is incredibly important, is that no one of those financial writers talk about risk-adjusted returns.
Yeah.
All right? So when you actually have someone who delivers to you 50% returns with a volatility of 25%, would you actually buy someone who offers you 100% returns with a volatility of 60%? What do you think you actually get? So again, it depends. You need to see, kind of put it into the context of how you define
in
risk.
Your portfolio. And this is something that, as an investor, you might be thinking about as part of your portfolio.
So people focus on one variable of the equation, which is what sort of returns am I going to actually get into this? Now, the second point that I think...
You can't blame them for asking that, though.
Well, but that goes back to financial education. It goes back to what we actually
any serious investor that only talks about returns is not serious investor.
Yeah.
I mean, exactly. It's stupid. Like Bitcoin is just on the capital of, on the efficient frontier is just like the marginal risk asset.
Yeah.
There's no difference. It's like the newest thing that's come that's an investable asset class now, but it's still on the curve of risk and return. If you just forget about risk, then you're the idiot. Like it's, I'm sorry. Like,
well, it seems.
The other point that I think is kind of interesting, and I want to probably, I know that we just getting into the time, but I think it's crucial for people to probably kind of think about it, is, you know, how much innovation you get from this trial and kind of people bouncing new ideas. And I'll tell you, I spent a lot of my professional career working in TradFi. And you can see the evolution of TradFi has been kind of small steps because, you know, a lot of the regulation, a lot of the problems, a lot of the issues you have. Now, when you have something like DeFi, I mean, you see things that traditional finance have never been able to do.
Like?
For example, yeah, I mean, I just met with someone this morning, which is fantastic, perpetual options. Can you imagine that? Can you imagine someone in TradFi quoting you perpetual options?
Yeah.
Well, no. Okay, so, well, you have it here in DeFi. So again, you may say, okay, well, what are the risks and this and that, and you know, what is the volatility of that funding rate, and so on. And it's just, but imagine, it's very interesting proposition. Look at what crypto kind of implement in perpetual futures, which is something that TradFi have never managed their heads to do.
It's remarkable. And we've seen other kinds of innovations. For example, it's not just the yield on these things, but being able to rehypothecate those yields and use them elsewhere.
Correct.
You see really sophisticated, I mean, not that investment banks can't create those products, it's just it's really expensive to do so, and there's a rather limited market for that. Wouldn't you agree?
Yes, and of course, like, you know, there's so much inertia in that system. It doesn't want to change. It doesn't have an incentive to change.
Well, I don't know if that's true. We've got a big bank over here, and I'll say that there's innovation happening at these banks. It might not be quite at that same pace.
I mean, I worked for a bank for a long time.
Well, Evy currently works
No.
It does work slower than when you have
Banks and
regulator overseeing you, and you can build and launch. It's in a very different state. Like crypto is in a very different state than financial institutions. But back to it, I think, yes, a lot of things can be looked at and invented. And who's really doing it, and who's really participating in it, and who's actually going for the perpetual futures, and who's making money off it, and got to think about all of that too when you look at these products. But it's true, many things do get explored, and it's great to have innovation and see if it works, but it hasn't yet been adopted by the big institutions.
But it's also kind of an unfair comparison as well, because banks are constrained by regulation to a massive degree. DeFi is not constrained by regulation.
Well, and
not yet.
The regulation, and as well the fact that they have agency issues. Like, for example, you speak to every single broker, and they say, by the way, we're going to take away from you the fact that you can roll contracts every 3 months, and how much turnover that generates by actually having a perpetual instrument. Well, I mean, tell me what broker will actually move from that.
Yeah.
Right. So there is a lot of different things. You can't point it out in one single thing.
To summarize, I think, you know, this thing, what Javier is saying, I think is, you know, without speculation, there's no innovation.
Correct.
The two sides of the same coin. This was true in VC, in Silicon Valley. It's true in crypto too.
Without speculation, there can be no innovation. I like that line.
Yeah, they're two sides of the same coin. It's just it's part and parcel.
Move fast, break things.
Yeah. Well, we've certainly seen a lot of breaking things in crypto, that's for sure. And it does seem to move pretty quickly, 24/7 markets and all. What are you seeing as, I just heard perpetual options here. What are you seeing as the most exciting, relatively new development in DeFi?
I'm biased here.
You might have a bias.
Because we're the one that's built the perpetual option. So,
okay.
So Javi kind of like teed it up for me. You know, there's two things we're super excited about. One is, Arthur Hayes, who opened the conference, he launched obviously perpetual futures. You know, we think perpetual options is to dated options what perpetual futures was to dated futures. So fundamentally, very, very excited about that, because I think it's something DeFi for the last year or so. There's not been that much new innovation. People are just kind of like taking the same mechanisms like AMMs, et cetera, and just doing more things. But you know, we think,
or just rolling out a new chain.
Or exactly, just deploying on a new chain. We think this is something fundamentally new, and we think we have cracked the code. So very excited about that. Excited
to see what happens there. What would you say is the most exciting innovation you've seen in DeFi in the last year or so?
I would say generally stable coins, and especially yield-bearing stable coins. Like, well, previous panel spoke about RWAs. I know basically what BlackRock is doing with BitO. What on the other side of the spectrum, what Athena is doing with USD. It's all very exciting because it gives people opportunity to have relatively like, okay, don't necessarily like, I don't know, that's safe.
Don't quote you on this. So it's relatively safe
Like,
exposure
to me,
yield.
what's important,
Yeah.
with both
Risk adjusted.
with both those things, you actually understand where the yield comes from, like from treasuries on one hand and from basically perpetual yield on the other side. Like you actually understand it, unlike like with Terra, yield was just coming from all the venture investors.
That was a pure Ponzi.
A lot of I mean, yes, but it was also ultimately it was sponsored by the foundation, and we do see a lot of it. Ultimately, like if you want to launch a lending protocol these days, you have to subsidize yield on your lending protocol, because why would people switch from Aave to you? And we see it, but ultimately, to me, emergence of those yield-bearing stablecoins, it's quite important because it can be a pretty important building blocks going forward.
Mm-hmm. I agree. I think it's very exciting. Javier.
I think it's several things. I mean, I probably would say that the pace of how DeFi is kind of moving is pretty interesting. Okay, so we moved, for example, from not being able to actually even have a ladder when people actually execute and trade to now you can find tools that allows you to do that. You move to contracts. I mean, so kind of whatever you kind of in some ways perceive it to be before a centralized exchange, you kind of getting closer and closer on the DeFi side. And that's a great opportunity for people to increase volumes, to do more trading, to do more instruments and so on, which I think, the all beautiful things that happens here, that everything lives in the change. It's all on change. And the more tools that people is going to have in the on change, the more the business is going to grow and the more people that are going to come out with ideas. But I think the backstory to me, which is very important, is that said, there is risk. Of course, there is risk. Like in tech, I mean, you mentioned, you do it and break it. I mean, it's similar in crypto and similar in innovation. But the fact that you actually have people that allows you to basically make those decisions for you and evaluate and basically scan the universe is the best thing.
Okay, I totally understand selling your own book here, but I agree. Right. Active management seems to be of real value. Evie, I'm going to adjust the question just a little bit. What would you say is the most exciting thing that your organization has rolled out in the last year when it comes to crypto?
Okay, I'm going to actually answer the question on DeFi because I don't think
even better
everybody knows that. We did do under Project Guardian, which is organized by the MAS and with other
That's the regulator in Singapore.
That's the regulator in Singapore. We did do an adaptation of DeFi with SBI and UBS to do an FX and government bond purchase and do repo. It was an adaptation of DeFi, adaptation of Uniswap, on which we did that. So we did check whether that worked, and we did do all of the groundwork of how to make that work in the traditional finance space. So it's not so that banks don't look at this. UBS was there, we were there, SBI was there to do this project and to test it out. There's a lot of work that needs to be done for it to be viable for global financial markets, but it's definitely something that is still being explored.
Do you see, I mean, at least early signals of upside there or benefit?
It worked. It proved that it worked. Like technically, it all worked, but there's a lot of work that needs to be done on the legal front, on the global in the global space for that to become viable for financial markets. Mm-hmm. But technically, it works.
Yeah. So I do want to ask you, of course, someone with the DEX. Do you believe that we're going to see more volume moving from centralized exchanges to decentralized exchanges? Is that going to happen in the near term or the long term? Because it does seem like the advertising dollars are still with the centralized exchanges.
Yeah, I mean, unquestionably, I think the tech was not possible before. So, for example, if you're trading on Binance or any of these large exchanges, they give you things like portfolio margin, things like that, which computationally, it's pretty much impossible to do it fully on chain. The logic needs to be on chain. But that was not possible before because gas was super expensive, small L1s were super slow. But now with L2s and the new L1s that are the fast L1s, all of this is possible. We've built our own chain. We're the first DEX to offer portfolio margin fully on chain. So basically what that means is we can't pull an Alameda on you. Effectively, because all the code is there, you can see all the funds, etc., and you can just prove it yourself. So now the tech exists. So because the tech exists, that unlocks capabilities. Those capabilities combined with the token and more incentives, I think now you will see kind of a new age where you will see a lot more of this CeFi crypto now move to DeFi.
Would you agree? Are we going to see more on DeFi, more in the DEXs less than the SEXs?
I would say, yeah, I would agree. It's like the next frontier is to be able to allow portfolio margining, to allow basically easier leverage as well on that, basically replicating the traditional system with prime brokers and everything. If we can solve this with DEXs, yeah, nothing can stop them.
Nothing can stop DEXs. You heard it here first, everyone. Thank you so much, panelists. Great chatting with you.
Thank you.
Thanks.